So, thank you so much. Thank you, IFPA, for having me on for today. And before I start, let me congratulate all the students who've excelled in their studies. I had the privilege of gifting them today, and happy birthday to all of you. Uh, uh, it's amazing actually. I got a feeling that I've become a Santa Claus today. But good for me. Uh, and congratulations and best wishes to the new team. I think you are all doing an amazing job, and look forward to interacting with you more in future as well. So with this, I represent Tata Mutual Fund, so I'll give you our perspective of where we see the markets and what would be our recommendations for your investors. So I think we are in a phase where there are more questions than answers in everybody's mind. I remember I had come here at this stage 2 years back. And at that time, there was all-round bullishness. And I was asked to speak on small caps since I manage a small cap fund. And I had given a positive outlook, and I actually had talked of manufacturing as a theme in India at that time. Since then, things have progressed very well. And I'll come to that, but so just to recap, last 12 months, Nifty is between +2 and -2%. Small cap is -7 to -10. And mid cap is -3 to -8. So last 12 months has certainly been a challenging phase for most investors. But the interesting thing is, thanks to you all, investors have continued to do SIP. And this trend continues to gain month after month. We see investors not losing, or they are optimistic. I would say that we are in a time where, or let me start by saying that we should bring investor expectations to moderate levels. So my observation is that, and this continues probably even today, wherever I go and meet across the country, between 2022 and 2024, the kind of returns that investors have made, and it's generally returns like in small cap fund, we generated 30% CAGR between 2020 and 2024. So the expectations are that 20% is easy. And that's the bare minimum that an investor today looks for. However, our observation is that incrementally it is, or let me step back and give you a perspective, is that though between that period 30% CAGR happened, but when you think from a small cap index perspective, earnings have grown between 2021 and 2025, the year that went by, at 16% CAGR, 1/6. And small cap index returns have also been around 16% CAGR. What happens is that, first of all, the conclusion that you should drive out of this is that earning growth is the driver of returns. If profits is growing at 16%, you should not expect returns to be higher than that sustainably. So what does happen is that there are some years where returns are preponed, and there are some years where returns are postponed. This year is one such year where returns are getting postponed. Last 3 years were a period where returns were getting preponed. So we all made good money, but profits were growing at the same pace. So our observation and recommendation to you all is to focus on profit growth, because that is what will drive earnings, or that is what will drive returns for you. So I want to spend some time on where do we think profit growth will be, and why do we think the way we think. So I want to take you to 2023 again, the year when I was here. And I would recommend you all, everything is available in YouTube nowadays. In that period, 2023 was the early phase, but 2023 and 24, those 2 years, the government and the Reserve Bank both were saying that economy is overheating, meaning that at that time, if you remember, expectations were that GDP in India will grow at 8% for a very long period of time. We have arrived in the world, and without us, the world will not function. And not only that, but the inflation was starting to go on the higher side, and both the government and the RBI were cautioning the economy and the market that we do not think this is sustainable, and more like 6.5% to 7% growth for India is sustainable on real terms. So that period was the period where both the government, and incidentally that period was, or the year was, where our government was trying to reduce their fiscal deficit. So during COVID year, as we know, 2020-21, government spent significant amount of money as stimulus to stabilize the economy. So that year the fiscal deficit, central government fiscal deficit was 6.9%. This year is likely to be 4.4. So in the last 4 years, government has reduced their fiscal deficit by 250 basis points. What does it mean? It basically means that the government spending was lesser and lesser compared to GDP or the economy. GDP is basically income of the economy. So if the income was growing at 10-11%, government spending was not as much. And hence fiscal deficit came down. Additionally, RBI was focused on inflation, and RBI was pushing, one, it increased interest rates, two, it reduced or it worked in a manner to control credit. For example, for some time we did see personal loans becoming bad. Right now we are seeing microfinance loans having a problem. So the RBI kept on cautioning banks that you are taking extra risk, please try and reduce risk. RBI also pushed the banking sector to control lending to the NBFC sector. And the reason why I'm putting what RBI did in more detail is because this is what matters for any economy. Money, it is in our language, in our markets, following the money helps you know where the market will head towards. So if money is tight in the system, growth tends to suffer. Regulations were built regulations came up to control growth in the credit, which ultimately meant that liquidity in the system was very weak. So on a daily basis, banks were borrowing from the RBI of something like 2 to 3 lakh crore every day. The result of that was that this year we are seeing, so it works with a lag. So if RBI is tightening things in 2023-24, the slowdown happens in 2024-25 and 25-26. So what you are seeing today is because of actions taken by the government and the RBI 2 years back, 1 year back. So in that sense, the market is reflecting slowdown today, but the actions were taken 1.5 to 2 years back, which means that you should follow what the RBI and government is doing today to see what can happen 2 years down the line. So and the good news is that in the last 1 year, markets have stabilized. are consolidating in a range. Expectations are coming down. I have been meeting partners since morning, and the general question that I have been getting, and not only here but everywhere else, wherever I have traveled, the questions are that should we be worried or not? And this is a good news. In fact, in my opinion, this is a very good sign that people are reflecting on the extreme bullishness that we have seen in the last 3 years, and will it be sustainable or not. Coming to today, what is happening, if you notice, the government is saying that I want higher growth. So in 23-24, as I said, government was trying to reduce growth rates. Today, government is wanting to increase growth rates. So February budget, they reduced tax rates for all of us. Just recently, they have increased from September 22nd, it will be implemented. They have reduced GST rates materially. So these are big stimuluses that the government is doing with the motive that growth needs to move higher. So government is pushing for higher growth now. Think about what RBI is doing. So since February again, so it is coordinated efforts from both sides, like it was in 23-24 on the reverse side. This is on the positive side. RBI has cut rates by 100 basis points. They've also cut rates aggressively on CRR, which means that liquidity in the system is, instead of negative 2 to 3 lakh crore daily on a system-wide, banks were borrowing from the RBI. Today, our banks are lending to the RBI on a daily basis or giving back to the RBI on a daily basis because they have surplus liquidity. So a reverse has happened, and RBI is also motivating banks to lend to NBFCs more actually, or the government is also doing that. So basically both the government and the RBI today say that inflation is lower than normal. We are not worried about inflation. In fact, we want higher growth. What does it mean? If bad things happen with a lag, or slowdown happen with a lag, higher growth will also happen with a lag. So if you think that way, at least our view is that FY27, the year that we are entering soon, we are in second half, or we are just about completing first half of FY26. We think FY27, businesses or economy will start growing at a faster pace. Business environment will be better. Credit growth will be better, which means that earning growth for corporate India will also be better. For example, Bloomberg consensus. So just to put things in perspective, the reason why this year markets are slow, one is valuation, because we preponed returns earlier. But the more important point that I want to highlight is that FY26, the current year, profits for corporate India is likely to grow at between 6 to 8% as per Bloomberg consensus, which is a very low number. So when growth slows down, return also slows down. Bloomberg consensus for next year and the year after is back to 14 to 18%, in that range. And we agree. We think that it is very possible with the efforts that we see in the economy. We think next year things will, all indications tell us that next year will be far, far better than what this year is. Or there is the potential for things to improve, which means that this is the time to start becoming optimistic again. Not yet there. We still have 6-9 months to go. Actually, I hope that we see more consolidation for next 6-9 months. In the process, valuations will become even more normalized. So you don't need to hurry. The conclusion is that lump sum is not required yet for your investors. You need not push them to invest in lump sum mode. But it's a good time to continue to do SIP, STP for with a view that the next 6-9 months could remain with weak returns, but FY 27, 28, 29, those 3-4 years is where you make your returns. So that's one argument. The second thing that I want to highlight, and this is my personal view here, or let's say our view at Tata Mutual Fund when we debate internally, and take it with a pinch of salt, do your analysis, as they say, listen to everybody's view, do what you like. I am giving my view, which is that if you notice how returns happened between 2022 and 2024, since every company was growing at a fast pace on earnings, stock prices were moving every day, every week higher, there was this momentum in the market, which meant that you needed to be in the market blindly. Stock selection was not important. The more you invested, you just closed your eyes, pinpointed your finger on a stock, and you made money. So it was that kind of market between 22 to 24, because we were coming from a very low base of earnings during COVID years. So it was easy money for most investors. We have entered a phase where incrementally business earning growth is not going to be common across the board. What I mean to say is that within large cap, mid cap, small cap, all segments, or any sector that you look at, there will be wide divergences in earnings. For example, from what I explained on what RBI and the government is doing, we think banks will start growing faster, or their profits growth will be faster and more sustainable going ahead. On the other hand, we have IT sector, which will probably continue to be slow. We think consumer discretionary will probably pick up in growth. On the other hand, sectors like pharma, capital goods, industrials will probably slow down from where they are today. So it's a mixed bag on sectors, and within sectors, individual companies will do well because of their management quality and their investments in the business, and some companies will not do well. What does it mean? It basically means that stock selection will be important. What does it mean for you as investors in mutual funds? It basically means that, or let me step back and tell you this story. I'm sure you would have done this analysis yourself. But between 2022 and 2024, the more diversified your fund was, the better your return was. I'll repeat. Any category you see, large cap, mid cap, small cap, large and mid cap, multi cap, flexi cap, you look at any category. Any fund house or fund manager which was owning 100, 200 stocks, the more the better, did better than fund managers who owned 50 stocks or lesser stocks in the portfolio. It was a market which was, or in other words, index funds did better than active managers in many cases. It was a phase where market was booming and momentum was there. We have reached a phase where when earnings dispersion starts, when some companies do well, most companies do not do so well, on the base you are likely to see concentration working better than diversification, provided you have the right stock picking. Let me explain in a different manner. Between 2022 and 2024, BSE 500 did better than BSE 200. BSE 200 did better than BSE 100. BSE 100 did better than Nifty 50. Nifty 50 did better than BSE 30. That was the nature of the market. I think the next 2, 3, 4 years, and this is my view, take it with a pinch of salt, I think BSE 30 will do better than Nifty 50, Nifty 50 will do better than BSE 100, BSE 100 better than 200, 200 better than 500. That's the market where we are in. So so I would advise that now when you choose a fund for your investors, be conscious of this fact and try and pick and choose funds, houses or fund managers who you think are on the right track in that sense, who are picking and doing right stock picking in this market environment across categories. The other thing that I want to talk on is that in the last 4 years, and rightly so, all of you and most investors have benefited by investing in sector funds and thematic funds. In fact, in the mutual fund space, 40% plus of corpus on a monthly basis has come in sector fund and thematic fund in the last 4 years. I think that story is over. So you need to go to diversified funds now. I think we are entering that phase. For example, I remember when I, 7, 8, 10 years back, we used to all recommend flexi cap funds and multi-cap funds when it started, and large and mid-cap funds and all. So we used to all recommend diversified funds. But then that time came where risk-taking ability changed and we started recommending sector funds and thematic funds. Like defense fund became a big thing in some years in the past. Capital goods, manufacturing became a big thing. But I think given where we are today, I would advise to have more diversified funds again in your portfolios. So if any client of yours has lesser exposure to diversified funds, please think again. Or please consider having a larger allocation there. The last point that I want to highlight on is that, I want to end on a positive note, which is a perspective on how cycles have had or where we are in the cycle. So 2008-9, listed companies universe, if you take all listed companies in India, and if you add the total profits that these companies delivered in 2008-9, and then calculated as a percentage of GDP, we were at 6.8, 6.9% in 2008-9, which was the last peak of our markets. From 2009 to 2020, as you all remember, we've had a very long, challenging phase of our career, where GDP was growing at 12% every year, but profits were growing at 3% every year. Slow, all of us made suboptimal returns between 2009 and 2020. So it was a long period where we didn't make money enough. In fact, I remember I used to be in a different company at that time, managing HNI money in PMS. And my client used to tell me that I make more money in fixed deposit, why should I give you fees? And I'm sure you would get that, you would also have got those questions. But the point is that because of that slowdown, 2020 profit to GDP was 1.7%. So our base was very, very low. Today, because companies have done so well in the last 5 years, we are at 5.2, 5.3% as profit to GDP. So we have bounced back very sharply, still below our previous peak. But one thing I want to add here is that in the last, let's say from 2009 to 2025, in the last 16, 17 years, average corporate profit margins have gone up by 400 basis points. So margins are better, which means that profit actually, absolute profit is better. Capital employed is better. Balance sheets, companies don't have debt only on their balance sheets. Return on capital employed is better. And lastly, there are lots of new companies that have got listed, which means that this profit pool is not the same as what it was in 2008-9, which basically means that we may cross, or we should logically cross 6.8% very easily in this cycle. What it tells you is that we are not even close to this cycle peak. So it's too early to be negative on the markets. I think our cycle is still there to go. Business activity is not yet fully bloomed. It actually blooms fully when leverage in the system goes up. So the moment you see corporate debt as a balance sheet, see for example, I'll give you one more data. 2008-9 debt to GDP, corporate debt to GDP was 86%, which was not an all-time high, but a high number. We are at 42% today. Very, very low. So the moment you see this going beyond 65%, you should start questioning the cycle. So I would suggest look for this data. The next time you want to review whether we are taking too much risk or not in a cycle perspective, maybe this data point will help you decide where we are we taking too much risk? So my submission to you all is that we have few years to go. It was because of some specific reasons why we slowed down for 1 year. That reason is today already changed. RBI and government both are pushing for growth and higher business activity, which makes me believe that the next 2, 3, 4 years should be a period of steady, strong earning growth for corporate India, which makes me believe that returns in our market should be reasonable. The bottom line is reasonable. So where I started, I will end is that please guide your investors to have normal return expectations. If return expectations are moderate and normal, I think they will not be disappointed. And FY27, I am very hopeful, should be a good year from that perspective. So with this, I will stop and thank you so much.